What if the US Federal Reserve's decision to pause rates was a harbinger of doom for the economy, rather than a sign of stability? Now, that's a provocative question. If we look at the recent news, Big Short investor Steve Eisman warns that this could be bad news for stocks. The Fed's decision to halt its interest rate hiking campaign next week could indicate fear and uncertainty. This decision, triggered by the US regional banking crisis, has stirred up quite the debate. There's speculation that the Fed's pause might soothe financial markets, but Eisman argues it could also lead to a flare-up in inflation. So, is the pause in rates a sign of fear and uncertainty, or a calculated move to manage inflation? Let's dive in. The Federal Reserve's decision to pause interest rate hikes is a significant one. Here's why. The Federal Reserve, often simply referred to as the Fed, is a central banking system in the United States. It plays a crucial role in managing the country's financial and economic conditions, primarily through adjusting the federal funds rate, also known as the interest rate. Now, when the Fed hikes the interest rate, borrowing money becomes more expensive, and this, in turn, slows down economic growth. On the other hand, lowering the interest rate makes borrowing cheaper, promoting spending and stimulating the economy. Now, let's dive into why the Fed decided to hit the pause button on rate hikes. The recent decision seems to be influenced by a combination of factors, including a regional banking crisis and concerns about inflation. According to an article from Business Insider, investor Steve Eisman warns that the banking crisis could force the Fed to halt its interest rate hiking campaign. The collapse of 3 banks in the past week has led to speculation that the Fed may pause its tightening campaign to soothe financial markets. In addition to the banking crisis, inflation concerns also appear to be a contributing factor to the Fed's decision. Eisman argues that stopping the rate hikes could lead to a flare-up in inflation. This is because when interest rates are low, people tend to spend more, which can drive up prices and, ultimately, inflation. A Reuters article also highlighted the Fed's calm response to an inflation surprise, maintaining its stance that inflation is transitory. Despite strong economic data, Treasury yields did not increase significantly, suggesting that the market has already priced in some inflation concerns. But as Eisman pointed out, this pause could lead to a flare-up in inflation. So is this good or bad news for investors? It's a tricky question, isn't it? Well, the answer might not be as straightforward as you think, and we'll delve deeper into that in our next scene. Stay tuned. Could the Fed's pause lead to a decline in housing markets and potentially cancel out a looming recession? This is a question that's been making the rounds in the financial world lately. Let's delve into this. The Federal Reserve's decision to put a pause on interest rate hikes can have a significant impact on housing markets. Normally, when the Fed increases rates, it makes borrowing more expensive. This, in turn, can lead to a slowdown in home purchases as mortgages become costlier. Conversely, a pause or a decrease in rates can make borrowing cheaper, potentially stimulating the housing market. However, it's not as straightforward as it seems. A myriad of other factors come into play, including investor sentiment, inflation rates, and the state of the banking sector. For instance, if investors interpret the Fed's pause as a sign of economic weakness, it could lead to a decline in housing prices as they pull back on investments. Moreover, while a pause might stimulate borrowing in the short term, it could also lead to inflation in the long run. Inflation erodes purchasing power and can make it harder for people to afford homes, even if borrowing is cheap. Then there's the banking sector. The recent collapse of 3 banks has sparked fears of a regional banking crisis. If this crisis deepens, it could tighten credit conditions and make it harder for people to get mortgages, regardless of what the Fed does with interest rates. So, what does all this mean for the possibility of a recession? Well, a recession is typically characterized by a broad-based decline in economic activity, not just a downturn in one sector like housing. However, given the housing market's significant role in the economy, a decline could contribute to a recession. On the other hand, if the Fed's pause leads to a boost in housing and other sectors, it could help stave off a recession. So, while the Fed's pause might seem like a good thing on the surface, its implications for housing markets and the broader economy are complex and multifaceted. What do the experts think about the Fed's decision and its potential impact on the economy? Well, there's a plethora of thoughts, opinions, and predictions swirling around. Let's take a look at some of them. Let's start with Steve Eisman, the Big Short investor who has been quite vocal about his views. Eisman has warned that if the Federal Reserve halts its interest rate hiking campaign due to the regional banking crisis, it could spell trouble for the markets. A pause from the Fed could be interpreted as a sign of fear and uncertainty. He believes that the cessation of rate hikes could lead to a flare-up in inflation. While some might see a Fed pause as good news for stocks, Eisman argues that it's unclear whether either move is beneficial. So, a bit of a mixed bag from Eisman. Then we have the stance of the Federal Reserve itself, maintaining that inflation is transitory. They project an air of calm, despite the surprising inflation figures. The market has already priced in some inflation concerns, and the dollar index is up slightly for the week. Now let's talk about the elephant in the room, the potential impact on investors. Some experts believe that a pause in rate hikes could lead to increased market volatility. The uncertainty surrounding the Federal Reserve's decision could lead to a cautious approach from investors. It's a bit like a game of chess, with everyone trying to predict the next move. On the other side of the coin, some experts argue that a pause could provide a much-needed breather for markets, allowing them to adjust to the current economic conditions. The pause could potentially provide a window for investors to reassess their portfolios and strategies. The views are as diverse as they come, reflecting the complex nature of our economy and the various factors at play. It's clear that the Fed's decision has sparked a lively debate among financial experts. As we can see, opinions vary on the Fed's decision and its potential impact. But one thing is clear: the pause has introduced a new level of uncertainty into the equation. So, what are the key takeaways from the Fed's decision to pause rates? Well, first and foremost, the reason behind the pause is the turbulence in the regional banking sector. The recent collapse of 3 banks has stirred up a sense of fear and uncertainty, forcing the Federal Reserve to put its interest rate hiking campaign on hold. This is a significant deviation from their usual strategy, and it's sure to have a profound impact on both investors and the overall economy. The potential implications for the economy are manifold and complex. On one hand, the pause could be seen as a relief for the stock market, providing some breathing space in a climate of high financial pressure. However, as investor Steve Eisman pointed out, this might not be the clear-cut good news it seems. If the pause is a symptom of fear and uncertainty, it could also herald a flare-up in inflation, which is a concern that can't be taken lightly. The housing market is another area that's likely to feel the effects of this decision. With the cost of borrowing remaining low, we could potentially see a surge in home buying, but it's also possible that the uncertainty surrounding the economy could lead people to hold off on making such major investments. The expert opinions we've looked at are varied and insightful. While some see the pause as a necessary step to soothe the financial markets, others warn of the potential dangers it could bring. In either case, it's clear that this decision has sparked a lot of discussion and speculation. While the future is uncertain, one thing is clear: the Fed's decision to pause rates has sent ripples through the economy that will be felt by investors and everyday citizens alike. As we navigate these uncertain waters, it's crucial to stay informed, keep an eye on the developments, and make financial decisions with careful consideration. And remember, every cloud has a silver lining. This pause might just be the catalyst for innovative financial strategies and investment opportunities. So, let's buckle up and see where this journey takes us. That's all for today's deep dive into the Fed's decision to pause rates. We've navigated the intricacies of the housing market, the recession, and expert opinions, all in the name of keeping you in the know. Imagine what else you can learn by joining our community of wealth builders and savvy investors. Don't hold back. Tap into the potential of staying informed about economic trends. It's easy as hitting that subscribe button. Thank you for watching. Remember to subscribe for more insights and analysis. Stay savvy, stay informed, and as always, keep building your wealth.